All right, let's dive into something really interesting today. We're talking about a unique financial tool that just tries, to give investors the absolute best of both worlds. The safety you get from a bond combined with the massive growth potential of a stock. Sounds too good to be true, right? Well, how does it actually work? Let's get into it.
I mean, just think about that for a second. What if you didn't have to make that tough choice between a steady, predictable income and the chance for your investment to just take off? This is the exact puzzle that the instrument we're looking at today, the convertible bond, is designed to solve.
So what on earth is this financial hybrid? Well, at its very core, it's a bond. Simple as that. But, and this is the key, it's got this powerful option kind of hidden inside.
Okay, so here's the deal. A convertible bond is basically a loan that you're giving to a company, just like any regular bond. But it comes with this really cool perk. You, the investor, get the right, but not the obligation, to swap that bond for a predetermined number of the company's stock shares.
Now, to really see what makes these so special, let's put one side by side with a regular or straight bond. A straight bond, well, it's straightforward. It just pays you interest. But a convertible bond gives you that interest plus the potential to cash in big time if the company's stock soars. So what's the catch? Well, for that chance at a bigger prize, companies will usually offer you a slightly lower interest rate. It's a trade-off.
I just love this analogy. The conversion option is like a sweetener, a little piece of candy tucked away inside the bond. It's this extra bonus that makes the whole deal more appealing, and, it could end up being incredibly valuable down the road. Okay, so that's the theory. But how does this actually play out in the real world? Let's jump into an example and see exactly how an investor would decide whether or not it's time to cash in that sweetener. So let's look at the numbers. We've got a company that's issued bonds where you can trade 10 of them to get 1 share of stock. Right now, each bond costs 120 agorit. At the same time, the company's stock is trading on the market for 6 shekels, which, of course, is 600 agorit.
So what's the play here? You're the investor. You're looking at these numbers. Should you convert your bonds into stock? Well, the answer is all in some really simple math.
The thought process here is super logical. First, we've got to figure out what it would actually cost us to get 1 share by using our bonds. Then we just compare that cost to the price on the open market. And from there, the decision should be pretty obvious. Okay, here we go. It takes 10 bonds to get 1 share, and each of those bonds costs us 120 agorit. So you just multiply them together, and you get an effective cost of 1,200 agorit to get 1 share. Now for the million-dollar question. How does that stack up against just buying it? And the math is, well, it's pretty clear. Our conversion cost is 1,200 agorots, which is double the market price of 600 agorots.
So the conclusion here is a big, flashing no. It makes 0 sense to convert right now. I mean, why would you pay double for the exact same stock you can buy on the open market? For this conversion to even start to look tempting, the stock's price would have to rocket past our break-even point of 1,200 agorit.
Okay, so we've seen why an investor would be interested in these, but that's really only half the story. Let's flip the script and look at it from the company's point of view. Why would they offer this sweetener to begin with? So there are a few really smart reasons. First, that conversion option lets them pay lower interest on their debt, which saves them cash. Second, it just makes their bond offering way more attractive to potential investors. But this third reason, this is where it gets really clever. Check out this super simple balance sheet. Before anyone converts, the company has this big loan, the bond, just sitting there on its books as a liability. That's a debt they owe, a debt they have to pay back. Now watch this. The moment investors decide to convert their bonds into stock, poof, that loan liability completely vanishes. It's wiped clean off the books and gets transformed into equity. The company has, like magic, reduced its debt, turning its lenders into owners. That can make its financial health look dramatically better.
And that right there shows you that these aren't just some quirky investment product. Convertible bonds are a really powerful tool that creates a direct link between a company's debt and its stock.
Now, this is such a great question. You might be thinking, hold on a minute. If the stock price goes to the moon, that makes the conversion option super valuable. So what stops the bonds price from just staying low? What keeps these two linked? Well, the answer is a powerful market force called arbitrage.
It works like this. Remember our break-even cost was 1,200 agorot, or 12 shekels? Now, let's say the stock price shoots up to 20 shekels, but the bond price hasn't moved yet. Smart investors will see this and go, wait, I can buy these cheap bonds, convert them into stock, and sell that stock for an instant risk-free profit. This rush to buy the bonds drives their price up until that gap disappears. The market automatically corrects itself. So when you look at the whole picture, this instrument is really designed to create a potential win-win situation. The investor gets the cushion of a bond with the exciting potential of a stock. And the company? It gets cheaper financing and this really clever path to cleaning up its balance sheet down the line. But of course, no investment is perfect. That sweetener is only sweet if the company's stock actually performs well. If the stock just stagnates or worse, falls, the investor is just left holding a bond that's paying them less interest than they could have gotten elsewhere. So, the question I'll leave you with is this: when does this financial sweetener end up turning sour? Thanks for tuning in. Welcome to The Explainer. Today, we're diving into a really fascinating corner of the financial world. We're talking about an investment that is, somehow, designed to be both safe and risky at the exact same time. Now, how on earth is that possible? Let's get into it.
I mean, it sounds like a complete contradiction, doesn't it? How can one single thing give you the security of a loan while also holding the wild, explosive potential of a hot stock? Well, that's the central puzzle we're going to solve today.
And here it is. The answer is the convertible bond. The easiest way to think about it is just like this. It's part loan and part lottery ticket. When you buy one, you're mostly just loaning a company money. That's the safe part. But stapled to that loan is your lottery ticket, an option to trade your loan for a piece of the company if it hits it big.
Now, that sounds great in theory, but the best way to really understand this is to actually walk through a deal. So let's do that. Let's pretend you're the investor, and you're checking out a convertible bond from a company we just made up.
Okay, so here are the terms on the table. The bond itself costs $1.20. At the same time, the company's stock is trading on the market for $6 a share. But the number you really need to pay attention to here is the conversion ratio. The deal is you can trade 10 of your bonds to get one single share of the company's stock. That right there is the key that unlocks this whole thing.
So, you've bought the bonds. Now the power is in your hands. For the next 5 years, you have this choice to make. Do you just hold on, collect your interest payments like a normal bond? Or do you pull the trigger and convert it into stock? This decision, well, it's everything.
Let's think this through. It's day one. You just bought in. With the terms we just saw, should you convert right away? I mean, just take a second and look at the numbers. Does that math actually work in your favor?
All right, let's break it down. To get one share by converting, you need to hand over 10 bonds. Since you paid $1.20 for each of those bonds, your total cost is $12. But wait a minute. You could just go on the open stock market and buy that exact same share for $6. You'd literally be paying double. So the answer is a huge no. At the beginning, converting is a terrible deal.
And this brings us to the absolute golden rule of convertible bonds. You only cash in that lottery ticket when the prize, the stock's actual market price, is worth more than what the ticket cost you, which is your $12 conversion price. It's that simple.
So $12, that is our magic number. That's the hurdle. The company's stock has to more than double from its current $6 price before converting even starts to look like a good idea.
But let's imagine the company absolutely crushes it. The stock price doesn't just climb, it skyrockets all the way to $18. All of a sudden, your lottery ticket looks like a genius move. You can now use your bonds to get your hands on an asset worth $18 for a cost that's locked in at only $12. That's an instant $6 profit per share. This is the whole reason you made the bet.
But you know, a move like this doesn't happen in a vacuum. A stock price that soars like that creates this fascinating ripple effect across the market, and it directly smacks into the price of the bond itself.
Just think about it. If the entire market can see that this little bond is basically a discount coupon for an $18 stock, what do you think is going to happen to the demand for that bond?
The force that kicks in here is called arbitrage. Now, it's a fancy-sounding word, but the concept is dead simple. It's just traders who profit from price mismatches. If you could buy a brand new car at one dealership for 20 grand and you knew another dealership down the street was buying them for 25, you'd buy and sell all day long until the prices evened out. It's the same idea. So here's the chain reaction. First, the stock price shoots up to $18. The arbitrage folks see this and their eyes light up. They're thinking, why would I buy the stock for $18 when I can effectively get it for $12 by buying up these bonds? So they rush in and start buying the convertible bonds. All of that new demand, of course, drives the price of the bond up too.
tying its fate directly to the stock. So we've spent a lot of time on the investor, but that raises a pretty big question. Why would a company offer this deal at all? I mean, it seems like they're just giving away a free shot at their future success. Let's flip the table and look at it from their perspective.
Well, there are actually 3 massive advantages for them. First, that lottery ticket we keep talking about, it's a sweetener. It lets the company pay a lower interest rate than they would on a plain old bond. Second, it just attracts a wider net of investors, people who want a shot at growth. But third, and this one is the real game changer, it gives them a pathway to just erase debt from their balance sheet.
Let's actually visualize this. Before anyone converts, the company's books might look something like this. Yeah, they have cash, but they're also carrying this big, heavy liability, the $150 loan from the bonds they sold. That's a lot of debt.
But now, look what happens after the stock takes off and everyone converts. Poof! The loan liability is gone. It just vanishes. It wasn't paid back with cash, it was transformed into owner's equity. The debt is wiped clean, and all those former bondholders are now new shareholders. The company is instantly in a much healthier financial position.
So after all that, what have we really learned? What is a convertible bond at its core? Is it debt? Is it a stock? The real answer is that it's this amazing, clever hybrid of both. From your point of view, as the investor, it gives you a safety net. If the company's stock goes nowhere, you're fine. You still get your interest and your money back just like a regular bond. But if the company takes off, you have this golden ticket to participate in that success.
And for the company, it is an absolutely ingenious financial tool. It's a cheaper way to borrow money today, with a built-in mechanism that lets them strengthen their finances tomorrow by turning that debt into a vote of confidence from new shareholders.
Ultimately, a convertible bond is a shared bet on the future. The company is selling a piece of its potential tomorrow to get cheaper cash today, and the investor is giving up a little bit of guaranteed income for a chance at that potential. It's a financial tightrope walk, perfectly capturing that tension between the safety of today and the promise of tomorrow. It all comes down to one question: whose future are you really betting on?